Hello and welcome to this episode of The Third Umpire. Now at Informed Investor, we are passionate about adding value to your life by providing daily and weekly market insights through various mediums such as recorded videos, live webinars and in-person workshops as well. Now to ensure we remain relevant and meet your needs, we value your inputs and welcome your suggestions on topics you would like us to cover. So drop your suggestions in the comment section below and we'll work hard to cover them in our forthcoming episodes. Let's grow and learn together. Now, in our third umpire episode dated 27th November 2022, we had discussed about how the Indian economy has been slowly coming out of the travails of COVID-19 pandemic. We discussed the second quarter results and how it had remained healthy despite several headwinds. While the top line, that is the sales, showed a growth, the bottom line, that is the profitability, had remained under pressure. Higher raw material costs and finance costs had continued to be a drag on the earnings of India Inc. So what exactly is the trajectory now? Let's discuss the Q3 earnings of corporate India in today's episode to see how the Indian companies are recovering by analyzing 4 key sectors, earnings, and also understanding how we should be navigating the current market volatilities. You're watching Informed Investor, the third umpire, an initiative by Research and Ranking. Let's begin. Now in Q3, Nifty 50 companies' sales growth was up 18%, while the earnings growth was up by 11%. The strong recovery in the auto and the banking industries contributed to the overall performance, but the results were negatively affected by a significant decline in global commodity prices, which impaired the earnings of metal and oil and gas. Just like several other quarters, the banking and financial services sector was the star performer in terms of earnings reported in the third quarter. We've spoken about banking and financial services sector in our special third umpire episode dated 11th December 2022, where we had invited our very own research analyst Franklin Moraes to gain some deeper insights into the credit growth. From a Q3 earnings standpoint, the banking and financial services sector led corporate earnings in the December quarter. This is on the back of rising interest rates, robust credit demand from the micro, small and medium enterprises and retail segments that have helped banks post record profits in the third quarter. Asset quality improvements further boosted the performance of the banks. For instance, India's second largest lender, the State Bank of India, posted a profit of 14,205 crores in the December quarter, which is the largest quarterly profit in the bank's 67-year history. Deposit growth has lagged credit growth. This was because many banks preferred using their existing liquidity to meet credit demand instead of hiking deposit rates. But this approach would now change as internal liquidity is said to have mostly exhausted itself. So, to meet higher credit demand, it is crucial for banks to catch up on the deposit mobilization. And banks are acting on that by raising deposit rates to entice potential depositors. Now, a fallout of the rise in cost of deposits and the cost of funds for banks would mean some pressure on the net interest margins. All said, banks have sailed through the third quarter with flying colors. As the pandemic lockdowns swept across the nation, the Indian automobile industry hit a major roadblock with factories, showrooms and supply chain grinding to a halt overnight. Now the industry was grappled with triple whammy of chip shortages, rising commodity costs and declining demand. But in the last few quarters, the auto sector has defied all odds and held its ground remarkably well. Auto sales volumes in the third quarter grew year-on-year across segments except two-wheelers. Healthy volume growth was underpinned by improvement in the supply of semiconductor chips and a strong order book, especially in the case of passenger vehicles. Commodity cost inflation moderated for the second quarter in a row. The same was reflected in margin improvement as most players benefited from a decline in raw material prices. Overall, the auto sector has seen some resilience in the past few quarters on the back of strong demand trends, easing supply chain constraints and the fall in crude oil prices. The IT sector or the information technology sector went through a weak phase in 2022, especially after outperforming during 2020 and 2021 when the COVID-19 pandemic forced companies around the world to embrace digital transformation. After facing headwinds on profitability for several quarters due to high attrition, IT companies had got some respite on this front in the quarter ended September. In the December quarter, India's IT sector clocked better than expected earnings as the demand momentum remained firm. The strong earnings of large IT companies for the December quarter have also offered clarity on the demand scenario, which is not as negative as it was previously anticipated. The deal wins for the quarter continued strong and remained high. Overall, the performance of IT companies has been good so far. The outlook for the IT services sector remains positive given the long-term growth in technology-related spending, resulting in sustained spends on associated IT services. But the potential occurrence of the recession in the UK and other nations does pose a threat to the growth of India's IT sector, as a large part of the sector's revenue comes from the US and other advanced economies. Now, the growing expectations of a recession in some of the developed economies suggest that spending on technology could possibly see a slowdown. Given the emerging macro headwinds and economic slowdown in the developed markets, the Tier 1 companies with robust scale and healthy balance sheets are likely to be in the survival of the fittest mode. The Indian FMCG sector witnessed improvement in margins and slow growth in the third quarter of FY23. However, the demand from rural markets continued to drag as retail inflation stayed at elevated levels. However, some improvement in rural markets is expected from Q4 on the back of upcoming harvest season and better minimum support prices. The prices of certain input commodities have corrected from their peaks, and the price hikes taken in the past quarters have led to gradual sequential marginal improvement in the third quarter. Having said that, there was a rise in the demand for fast-moving consumer goods across India throughout Feb 2023, as rural sales witnessed a rise in demand by 12.4%, while urban sales grew by 5.5% when compared to a year ago numbers. While a complete revival of demand in rural areas specifically may take some time, there are signs of growth as the Rabi harvesting has begun. As inflation remains in control and range-bound, and with hotter days ahead of us, coupled with the upcoming IPL cricket season, we remain extremely hopeful of a surge in consumption for the FMCG products going forward. Now that we've discussed the factors affecting the Q3 results of the key sectors, let's take a look at the trends stemming out of the Q3 results. The financial services, especially the banking sector, has seen an increase in earnings. Due to healthy credit growth, margin expansions and ongoing asset quality improvements, growth momentum for the banking sector has remained strong. The automotive industry has benefited from improving demand and a decline in commodity prices. We also saw muted profitability in the commodity space, that is, in the metals and oil and gas domain. Now, the rebound in the financial and auto sector is negating the effect of higher costs on the overall earnings of the Nifty 50 companies as seen in the third quarter. The negative impact of the unfavorable global economic and financial conditions is evident in sectors that are exposed to global demand. Sectors that performed well in the third quarter were mostly driven by strong domestic demand. However, there was a disparity between sectors that cater to urban population, which performed relatively better than the others. Looking ahead, there are indications of a recovery in the rural demand, improving consumer sentiment, and the expectation of a decrease in consumer inflation. These could have positive implications for sectors such as FMCG and consumer goods. Sectors in the infrastructure space may benefit from the government's efforts to accelerate the pace in capital creation in the economy. However, the outlook for sectors such as textiles, chemicals, iron and steel remains uncertain due to concerns about the global conditions. Now, the Q3 results of the key sectors have been fairly in line with expectations, and the outlook continues to remain fairly positive. You can always argue that the broader markets may differ from this as they have been largely volatile throughout the year. Well, evidently so, the Nifty has given returns to the tune of 5% only in the last 12 months. But no matter the cause, the market presents a fantastic opportunity for long-term investors. As Mr. Warren Buffett would like to say, it's time to be greedy. Why so, you may ask? Well, here are the key reasons why we believe so. First, the inflation is within manageable range and has begun to rationalize. In April 2022, the inflation in India peaked at 7.79%, but it has since then decreased and was recorded at 5.72% in the month of December 2022. However, in January 2023, it slightly increased to 6.52%, but it is still within manageable limits. The government's tax revenue buoyancy is extremely evident. The recent budget has revised the expected gross tax revenue receipt for FY23 to be at 30.43 trillion rupees, which is about 2.85 trillion rupees more than the earlier estimate of 27.57 trillion rupees shared during the previous year's budget. Now, in the first 10 months, the GST collection has exceeded 14.9 trillion rupees, showing a 23.8% increase from the previous year. Additionally, the direct tax collection up to 10th February 2023 indicated that gross tax collections have reached 15.67 trillion rupees, which is also 24.09% higher than the corresponding period in the previous year. Therefore, the direct and indirect gross collections have been significantly robust. Higher GDP growth than forecasted previously. The latest estimates from MOSPI show that the nominal GDP for FY23 is anticipated to surpass the previous forecast of 268 trillion rupees and instead reach 272.04 trillion rupees. This represents a substantial 15% increase from the FY 2022 GDP of 234.71 trillion rupees. It's worth noting that the Union Budget predicts an impressive 10.5% growth in the nominal GDP for FY24, which would result in a high base of 301.75 trillion rupees. Continued healthy growth in corporate earnings despite a high base. Although the corporate earnings have already shown robust growth in FY 2022, analysts predict that the earnings will continue to increase even more in the next couple of years. Now, the current valuation multiples at 17.6 times appear appealing when compared to the long-term average of 18 to 20 times, making it a favorable moment for investing. Rising bank credit growth and improving asset quality. Bank credit is on the rise and banks are experiencing an improvement in the quality of their assets. As of January 2023, the total credit growth has increased to 16.3% year-on-year, amounting to 133.4 trillion rupees. Additionally, the gross non-performing asset ratio of scheduled commercial banks has continued to decrease, hitting a low of 5% in September 2022, which is the lowest it has been in 7 years. The Warren Buffett indicator on India's market cap to GDP ratio dropping below 100%. Now, the Warren Buffett indicator, which is the ratio of the total market capitalization of all publicly traded stocks in a country to that of the country's GDP, is currently at 97.2% for India, based on the country's nominal FY23 GDP second advance estimate at 272 trillion rupees. Now, this suggests that the Indian stock market is almost equal in size to the country's economy. A ratio above 100 would indicate that the market is expensive, so it's safe to say that the Indian markets are definitely not overvalued. So while the volatilities in the markets and multiple negative updates can lead to stress, we urge you to look at the bigger picture. The long-term investing is like a marathon race where consistency and persistence pay off in the end. As investors, we all know that the market can be a roller coaster ride if we are investing for a very shorter horizon, especially in the face of inflation, monetary tightening, and external factors. However, at ResearchAndRanking and at Informed Investor, we firmly believe in the power of long-term investing. Time and again, we've said that India's underlying fundamentals and growth prospects continue to remain strong, making it an attractive investment destination. During these volatile times, it's important to focus on quality companies with appropriate fundamentals, diversify, adjust risk levels, and maintain a long-term investment strategy. By doing so, we can navigate through uncertainties with ease. So buckle up for the long haul and join us in this exciting journey of wealth creation. As we wrap up today's episode, I would like to remind you to share your suggestions in the comment section below. Your inputs help us cover more relevant topics so that we can serve you better. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Stay safe and stay invested. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.